Welcome to another episode of the Einstein Retirement Daily, where we curate financial, economic, and market news for the headlines that affect today's retiree. Today is another common retirement questions episode, and in this episode it is sort of invigorated by a few blogs that I watch from time to time to see what kinds of questions people are asking about retirement. And this is a very common question we get a lot in our workshops, and that is, how much exactly is my RMD? More on that coming right up. As always, if you hear something in today's podcast that causes you to want to make some changes, take some action in your accounts or otherwise, or in your situation in any way, please be advised that this podcast should not be construed as specific tax, legal, or investment advice. If you decide to do something, take some action, please consult with the appropriate tax, legal, or investment professional who knows your specific circumstance prior to making any changes. Okay, so on today's podcast, what we're going to focus on is how do required minimum distributions work and how much do I have to take? This is a very common question that we get, especially in our live presentations, our live workshops. So invariably, because one of the topics in our presentation that we discuss is the issue of taxes over the course of your retirement, that is obviously going to highlight something called a required minimum distribution. When you pull dollars from your tax qualified accounts, so these are going to be 401ks, 403bs, 457s, IRAs, simple IRAs, SEP IRAs, any account like that, those withdrawals are going to be taxable. The reason for this is because when you put dollars into these accounts, you got a tax break. You got a tax deferral for putting those dollars in. As those dollars grow and they increase and you put more and more in, when it comes time for you to retire and you start using those dollars to fund your retirement, you will have tax exposure on those dollars as they come out. So if I pull $20,000 from my 401k on my tax return for that year, I will add $20,000 of income from my 401k as ordinary income, and so it's just 100% taxable, goes right to my taxable amount. So in the scenario where you are not maybe pulling so much, or you at least still have some dollars in your accounts, eventually you have to pull, so long as you live long enough. If you live past the age of 72, you must take a required minimum distribution. The old rule was 70 1/2. So when you hit 70 1/2, that was when you were going to have to start taking those required minimum distributions. In today's law, it's not 70 1/2 anymore. It is now 72 that you have to take those distributions. So that law was changed last year in the year 2020. Yeah. And so when they made the law change, basically what it said is if you did not already hit your 70 1/2 birthday by December 31st of 2019, your new required minimum distribution age is now 72. So, if you already hit your RMD age, 70 1/2, before December 31st of 2019, you are on the old life expectancy tables. Okay? A life expectancy table is used to determine what your distribution is on your IRAs or 401k accounts. Let's say you have $100,000 in a 401k plan, and you turned 70 on May 5th. Doesn't really matter. Just in May of 2019, you had to start RMDs that year in 2019, and you have to keep doing your RMDs. If you did not, if you're younger than that, you don't have to start your RMDs until the year 2022, and no more half stuff. It's just when you hit the age of 72 that you have to start taking an RMD. And RMD stands for required minimum distribution, and the way it's calculated is by using life expectancy tables or a divisor, okay? So if you want to Google for this, what you want to Google for is RMD table 2022. If you want to see the correct table, that's what you need to Google. RMD table 2022. If you Google that, you should find a table that will list these out. The numbers that you're seeing there are divisors. It's not a percentage. Common misconception. People think that I have to pull a specific percentage of my 401k balance. No, it's a divisor. The amount that you have to take is based on what the value of that account was on December 31st of the prior year. So in 2022, for those of you who hit 72, whatever the balance is at the end of this year, December 31st, 2021, whatever that balance says on that account, you must divide that number by 27.4. That's the number of expected years that you will live, okay? So the IRS tells you that they expect you to live 27.4 years. So if you have $100,000, you have to pull out $3,649 and change, or roughly 3.65%. But it is not a percentage. Don't use a percentage to calculate this. Use a divisor. Okay, the correct divisor in year one is 27.4. If you pull that amount, you're good. You have to pay ordinary income tax on it, ordinary income tax, but no penalties. You've covered your need. In the year that you pull your required minimum distribution, let's say you make a mistake and you don't pull enough. Whatever you were supposed to pull, the IRS is taking half of it. Okay, so if you make a mistake and you were supposed to pull $1,000 more, well, they're taking $500 of that, and you still have to pull it, and you pay tax on the full $1,000. Okay, so they take half of it, and then they're going to take the taxes yet on the remaining portion. So don't make a mistake about this. The required minimum distribution age begins at the age of 72 unless you turn 70 and a half prior to July 1st, 2019. Okay, every year that you age, your life expectancy goes down, and so your divisor number goes down. So for example, I mentioned 27.4. In year two, so when you're 73, your divisor's 26.5. 26.5 is what you would divide by. Let's say you earned your 3% back, so your account's still $100,000. It means you'll need to pull $3,778 and change. Okay, but again, it's not a percentage. It's not a percentage. It's a dollar amount. But the rough percentage is about 3.78%. Okay, but don't use a percentage. Use the dollar amount as your benchmark. Okay, now most custodians will give you this number. The custodian is the person that's holding your money, and not person, institution, big bank. You got your Schwabs, your TD Ameritrades, your Fidelities, your TIAAs, your whatever custodian, Wells Fargo, Vanguard. Okay, whatever the custodian is, they're the ones holding the account. They should report to you what your required minimum distribution will be. If they don't, get a new custodian, because most of them should calculate it automatically for you. Or, if you have a financial advisor, your financial advisor should also be doing this in spot checking and making sure that you're getting the correct amounts. Okay, do not combine RMDs from dissimilarly titled accounts. Okay, your IRA at Vanguard and your Fidelity IRA, you only have to pull one RMD, and you can pull it from either account to satisfy both. But if one of those accounts is actually a 401k, you may not combine those amounts. So combining IRAs and taking from one account is fine. Combining IRA and 401k and taking from one account is going to get you that 50% penalty. So don't make that mistake. Okay, I hope this was helpful. As always, we encourage you to subscribe to our YouTube channel, follow our Facebook page. We'd love to see you at one of our live events if that would be helpful to you. We have a lot of fun. We do a live workshop, we answer questions, and we have a good time. So we'd love to see you there. If that is of interest to you, send us a message to our Facebook page, and we'd love to interact in that way. With that, we will see you next time.